Let's talk about closing entries. Closing entries reduce temporary accounts to zero and update the retained earnings balance. So they include accounts such as dividends declared and anything that go into the income statements. So these include your revenues, gains, expenses, and losses. Well, why do we need to know the closing entries? Remember, net income equals to revenues plus gains minus expenses minus losses. And we frequently need to know what the net income is for each period. So imagine we need to know the net income for last quarter or last year or this quarter or this year. So setting temporary account items to zero for the beginning of the period will really facilitate with the income calculation process. Let's work on an example. BiteSizeQ&A company provided $1,000 in consulting services. They paid their employees $100 in wages. So let's work on the parts one by one. First, BiteSizeQ&A company provided $1,000 in consulting services. So what happened? Well, cash went up by $1,000 and they record $1,000 in revenue. So the journal entries would be debit cash for $1,000 and credit revenue for $1,000. Next, we can think about the payment to their employees. So they paid $100 in cash, so cash went down, and they incurred wage expense of $100. So the journal entries would be credit cash for $100 since cash went down, and we'll debit the wage expense for $100. Let's identify the temporary accounts. Revenue increases our net income, whereas wage expense reduces our net income, so these are our temporary accounts. Next, we have to close them into the permanent retained earnings account. But before we do so, let's look at their T account representations. Revenue increases the net income, which means it increases retained earnings and shareholders' equity, hence its beginning balance is on the right-hand side. And we credit it by $1,000. Wage expense reduces net income, which means it reduces shareholders' equity, so the beginning balance is on the left-hand side, and we debit it by $100. Our goal is that for both the revenue and wage expense, their ending balance should be zero. We'll use the retained earnings balance to help us. First, to make sure that the ending balance for revenue is zero, we got to get rid of the $1,000 on the right-hand side. How do we do that? If we close the revenue account by debiting $1,000 on the left-hand side, then they would cancel each other out, and we would have zero for the ending balance for revenue. If we debited revenue, well, we need something to be credited, so we'll credit $1,000 to retained earnings for the closing of the revenue account. Similarly, for expense, in order for the wage expense to have an ending balance of zero, we must credit wage expense by $100 on the right-hand side. If we have a credit of wage expense, then we have to have a debit of $100 on the left-hand side somewhere, and that will also come from the retained earnings account. So that at the end, after the closing entries, we'll have $900 as the ending balance for our retained earnings account. Now let's look at it in journal entry form. For revenue, our closing entry would be a debit of $1,000, so we'll debit revenue for $1,000. For wage expense, in order to close the account down to zero, we had to credit wage expense by $100, so we'll credit wage expense for $100. And that means we need a credit of $900 on the right-hand side so that the total debits equals to the total credits, and that comes from our retained earnings account. So now you know the closing entry will reduce any temporary accounts to zero and update the retained earnings permanent account. And now you know all about closing entries.